Welcome, everyone. Today, our topic is Charting Disruption, Outlook for 2025 and Beyond, presented by Ido Caspi. He is a research analyst with Global X ETFs. This monthly webinar is hosted by Lumina Financial Strategies, and your moderator today is Allison Fleming, president of Lumina Financial Strategies. Allison is a certified financial planner practitioner, and for those of you who may be joining us for the first time, I'll go ahead and introduce her. Allison has been a financial advisor since 1989 and serves clients in 29 states across the country. She holds a bachelor's degree in speech communication from Cal State Long Beach and believes that we must always adapt to the changing environment, remain current, and take advantage of opportunities to improve our clients' lives. Our local motto, "Be a long-term thinker, not a short-term worrier," serves as the cornerstone of her discussions. With that, I'd like to welcome your host, Allison Fleming.
Hi there. Great to see everybody. Thank you so much for spending your time with us today. I appreciate you taking your time on this Wednesday afternoon. I'm really excited to introduce Ido, but before I do that, if I could go ahead and introduce our team, then that will help you recognize everybody here. So we have Miles Fleming, who is our Executive Vice President and Insurance Specialist. I'll point out that Miles recently did a webinar on Medicare, and enrollment is coming up in October. So if any of you need help with that, please give him a call. October is the time of year. We're going to start getting spammed with all the emails about Medicare. So let us help you out there. Britt Stevens is our Vice President, and Peter Fink is our resident stock picker. We have Damian Feldman, our Client Experience Manager, who you maybe have heard from recently if you're trying to set an appointment here. We have Terry Jocelyn, who's our Executive Assistant and Administrative Manager in the office. Also, Maddie Uoa, who is up in our San Pedro location. If any of you are up in Los Angeles area, you will soon get a postcard for a grand opening for our new office up that way. We have Kaylee Kaufman, our Client Care Coordinator, who is full-time with us and will soon be changing her name because she got married last week. So congratulations to Kaylee. We have Justin Romine, who's our support specialist, working with Britt on all things investments and behind the scenes as far as your transactions and paperwork, etc. We have Lucy Adame, who's also working behind the scenes supporting Caress on a lot of our database projects and marketing things. Then, of course, we've got Caress Vera, your creative director of Voice from the Sky, and the leader of all things webinar. So thank you so much for everything, Caress. You've done a great job once again. Our disclosure slide here discloses everything you need to know about us. And with that, I would like to go ahead and invite Ido to join us here. And he's going to be sharing his slides in a moment. So Ido, it's great to see you. Thank you so much for taking your time. I know that you're on the East Coast, and so it's late for you. And I appreciate you staying after hours to talk to our group here.
Of
Appreciate
course.
it.
Of course.
Yeah.
Thanks for
And
having
we've
me.
been working with Global X for a while, especially on the specialty funds that we use in our clients' portfolios. And I know you have a specialty area in the sort of market disruptor kind of companies and exchange traded funds. And the fact that you're able to present to our clients is really much appreciated. So I'm just going to go ahead and turn it over to you to go ahead and lead in with your knowledge and information. And again, thank you so much for your time.
Of course. Thanks
All
for having
right.
me on. Let me just share my screen quickly.
Perfect. Thanks.
Okay, great. Thanks everyone for joining, and thank you guys for having me on. Excited to be here. This is one of my favorite areas to cover. As Allison mentioned, by the way of introduction, my name is Ido Caspi, and I'm a tech analyst here at Global X. So my day-to-day basis is covering disruptive trends, whether it's AI, robotics, cybersecurity, defense tech, fintech, social media, cloud computing. So the whole array. So it's a very fun job. AI, of course, has garnered the most interest. So that's what we'll focus on today here. But I guess before we jump into the bulk of the discussion, just quickly an overview of who we are at Global X. We are primarily an ETF manager. Here in the US, we manage about $70 billion as of today. But we are a subsidiary of Mirae Asset, which has about this deck is a little bit outdated at this point, but it has about 100 billion in assets across 300 ETF strategies all over the world. So we're not just here in the US. We have operations in Europe, Asia, Australia, Latin America. So we're a full global platform at this point. And I guess just to take a quick backdrop, we're going to primarily talk here about artificial intelligence. But one thing I think which is important to consider, and this is often what we hear from investors, is that markets go up, markets go down, markets are oftentimes highly valued, undervalued. Uh, Irrespective of where we are in the market, our view here at Global X is that, despite the market environment, innovation always persists. And despite what happens in the market on a daily basis, we see AI as kind of this transformative technology that we've never seen before. And we expect it to continue to accelerate, the adoption to continue to accelerate despite what the market does. And I think that's what's kind of the most important takeaway here is that we can't look at this theme from a 1 month, 2 month, 3 month perspective. We need to look at this at a 5, 10, 15-year cycle because that's really what this technology is. And we're still, believe it or not, only in the first inning. So I think this chart does a good example of just looking at all the previous, innovations of the last 20 years. Whether the market's up, whether the market's down, these innovations can continue to persist. And that's kind of what we're seeing here. If you look at the tail end here, 2023, 2024, ChatGPT was actually launched in a severe market downturn. So I think that's just a good perspective to have before we jump into this discussion, because oftentimes we hear from investors, is this a bubble? Is this hype over reality? I think, regardless of that, you need to consider the fact that these are innovations that are going to play out over the next 5, 10, 15 years. So what we're seeing in the market happen on a daily basis, shouldn't affect the way we view artificial intelligence. I think that's just kind of a good backdrop to have in mind as we go through this deck and go through the long-term potential of this technology that we'll be discussing. Again, just with that in mind, all these paradigm shifting technologies that we're going to be talking about, with each successive one, the adoption happens faster and faster. So if you look back to the early 1900s and you look at electric power, or you go to 1930 and you go to the automobile, the refrigerator, it took about 10, 15 years to reach 40, 50% of US households. The reason why there's so much excitement around artificial intelligence and all these developments is because unlike any previous innovation or technological paradigm shift, this has reached about 30 to 40% of US households in just about 2 years. So the rate of adoption is happening at a much faster pace. And I think that, again, we built this deck at the end of 2024. I think if we were to look at this chart at the end of 2025, as you see here in the bottom right, where generative AI is, I think this number will be much closer to that 60, 70% threshold, which is pretty amazing to think about just how quickly, this technology is being adopted. And I think that's why there's so much excitement around this space, and so much excitement around the names that are kind of powering this revolution. And again, just a quick backdrop at Global X, our primary, we have 100 funds at this point spanning, thematic ETFs, income ETFs, commodity ETFs, international ETFs. But I will say kind of the bread and butter and what we're most known for are these disruptive trends. And what we have here on this chart is you'll see all these themes are concepts that we have ETFs for. So what we look to do is find these transformative technologies far before anyone's talking about them and kind of build an ETF around it. And as you see here, we kind of look at disruption in 6 layers: innovators, early adopters, early majority, late majority, and then laggards. What we seek to do here at Global X when we launch an ETF or think that we have an idea that we want to bring to market, we want to kind of capture it in that innovators to early adopters phase, as you see on the left side of this chart. Because with that, you still have the rest of that S-shaped curve of adoption, as you see here, to kind of participate in that growth. We don't want to launch a fund too early, all the way on the left side of that innovator stage, because at that point, the theme is too nascent. There's typically not enough companies that are public to build a fund around, and the risk is still a little bit up there. But once you move kind of into that early adopters, early majority phase, adoption is there, as we showed with the chart. There's enough public companies, there's a large enough investable universe, but still at the same time, you still have that runway for growth, as you see on the right-hand side. A good example is our social media ETF. The social media theme at this point, when you think about it, it may sound a little bit more mature, and some of the growth has been is kind of behind us. But we actually launched our social media ETF before Meta even went public. I think it was around 2010, 2011. So it just kind of goes to show our forward-looking approach and how we try to kind of capture these themes and these, the trends that are reshaping markets far before anyone's even talking about them. And AI is actually one of them. So artificial intelligence, we have a fund for that, AIQ. We launched that in about 2017, far before anyone was talking about generative AI, far before anyone was talking about physical AI. And I think, for that reason, we've kind of garnered the assets and the performance that we've seen within the fund. But I wanted to lay this chart out, A, to show you kind of all the different themes that we look at here from our end on the research side, but then B, to kind of also point to lay it out on this S-shaped curve of adoption. Because I think capturing a theme within anywhere between that early adopters to early majority phase is really where you as an investor kind of want to enter. Not too early where the risk is extremely high, but not too late where you're still able to participate in that long-term growth trajectory. And so without further ado, we'll jump right into this discussion. This is actually part of a year-end project we put together every year called Charting Disruption, where we highlight our top 5, 6, 7 themes for the following year. So we put this PowerPoint deck together actually at the end of 2024. So what you'll see here is that some of the charts are actually a little bit outdated, and given just how fast this space is accelerating, the numbers are quite drastic just from December 31st, 2024 to where we are now in 2025. But this is just one chapter from the overall project. If you have interest in any of these other themes, whether it's robotics, defense tech, infrastructure and environment, or healthcare, highly recommend going to check out the rest of the PowerPoint deck to get some coverage into those themes. So jumping right in and focusing primarily here on AI. Again, taking a quick step back, why is this garnering so much media attention, so much investor attention, so much market attention? We've seen disruptive technology shifts in the past. Why is this one, creating more hype than ever before? And the reason is we actually if you look here on the left-hand side chart, we put this study together with JP Morgan, which I found really exciting. So if you look at all the previous innovation cycles that we've talked about, whether it's, the steam engine dating back to the 1700s, electricity, the automobile, the internet, and then cloud and mobile phones, none of those produced the productivity gains that AI produced in as short of a time. So if it actually we used 2023 for AI because that's essentially when ChatGPT and a lot of these large language models came to market. But it took about 2 years to reach productivity growth of 20%. Cloud and mobile between 2010 and 2024 still never reached the labor productivity upside that we're getting from generative AI. So it just kind of goes to show how transformative it is, what the potential it is for improving labor productivity, consumer productivity. And on the right-hand side, what does all that translate into? If you look at the profitability metrics for S&P 500 companies, we're at all-time highs. And why is that? It's because we're able to produce more at a quicker pace, at a cheaper cost. And so output is increasing, but input is actually decreasing. So we're able to move away from some low menial task jobs and use kind of these automated systems that we now know and love. And again, this is as of 2024, but profit margins had risen up to about 11%. Now they're closer to 14, 15%. So you can only imagine, what that trend will look like when we look at this chart, 5, 10 years down the line. And a key question we get from investors all the time is, companies are spending crazy in this space. CapEx is on the rise between all big tech. Is all this spending going to translate into meaningful, dividends? Are these companies going to see gains? I think that this chart on the left-hand side is a very good case study to look at. So if you look at CapEx through 2024, this is a little bit outdated, but in 2025, CapEx amongst the big tech 4 companies is projected to reach $400 billion, up from $250 billion in 2024.
Ido,
So I
can
think
you
that,
explain what CapEx means? Because I don't know that our audience knows.
yes.
Thank
So
you.
at a very, high level, CapEx is what you can view CapEx as what these companies are spending to kind of build out this technology. Of course, it's not all going to AI. When you think about CapEx, it's what is a company spending on the back end? What are they investing in? It could be in property, it could be in real estate, it could be in technology, it could be in software. But it's kind of where is where are these companies investing? And if you look at what big tech is doing, they are spending more aggressively on, AI infrastructure and AI technology than any previous, technological cycle of the past. Again, as I just mentioned, in 2025, the big four companies, Amazon, Microsoft, Google, and Meta, are projected to spend $400 billion on AI CapEx. And just for perspective, I know that number doesn't mean a lot when you just hear it, but if you look at some of the previous, cycles of the past, whether it was the telecom boom or the big oil boom, and this is what I'm showing on the right-hand side, just four tech companies, Amazon, Microsoft, Google, and Meta, spend more on CapEx, so more on kind of the back-end investments than every single telecom service provider did in the 2000 telecom boom, and every single oil company did in 2013 during the big oil CapEx boom. So four companies today are spending more on building out this new wave of innovation and this new technological cycle than kind of a whole industry would do in the past during their boom. And for even further perspective, the other 90 S&P 500 tech companies in 2024 didn't even spend as much as these big four that we're talking about. And that number only continues to rise. And I think that kind of is a good perspective for investors to have, because if these companies at their scale are still investing this aggressively, there must be a long-term potential that they see. And as investors, CapEx is a good metric to look at because if Meta, Amazon, Google, all these big tech companies are spending on this technology this aggressively, the potential is there, and we as investors should kind of follow suit and invest in what they're investing. So I think that's kind of a good perspective, because investor capital always follows, kind of that enterprise capital. They show you where the puck is going, and we as investors have kind of the opportunity to follow them. So that's why, looking at what these companies are spending on is kind of an important metric to follow. And then that brings me to kind of this next part. Obviously, the spending is there, the adoption is there. Everyone is hearing about, generative AI. Where can we as investors, participate? Where can we benefit from this? Early in the cycle, one concern we would hear from investors is, there's 3, 4, 5 companies you can really invest in. NVIDIA being one of them, of course. You have AMD, you have these big four tech companies that we're talking about, Amazon and Google. But at this point, just in the 2, 3, 4 years since, AI really came onto the scene, we've really created a whole new kind of ecosystem of companies that we as investors can invest in, which 2, 3, 4 years ago we would have never even thought about. So this is my way of saying that, just 2 years ago, there was like I'm almost admitting to, there was only a handful of companies you could really invest in. Of course, OpenAI was private, so it was hard to kind of participate in this trend. If you wanted to get into NVIDIA, we often hear that, valuations are kind of high and, we may have missed the boat. But this slide, I think, does a great example of showing just, this whole AI ecosystem is broadening out very rapidly right in front of our face. It's going to play out in multiple different derivatives. So you as an investor, if you may have missed that kind of NVIDIA surge, there's a whole slew of other companies now that are kind of further down the value chain where you as investors can invest and capitalize on the growth of this industry's trajectory. So the way we look at this whole space at Global X and the way we construct our AI-related ETFs is we look at it in kind of 3 layers. Actually, 4. You don't see it on this slide. I'll get to that later. But we think this whole wave will play out in 4 layers, with each layer offering investors a whole slew of companies to invest in. So, of course, that semiconductor value chain, which you see here on the left side, is crucial, of utmost importance. It's kind of the picks and shovels or the backbone of AI. Everything we talk about, whether it's ChatGPT or, any of these other large language models, none of that is even remotely possible unless we have kind of that core infrastructure in place. So the semiconductors are crucial for building out this whole data center build out, this whole AI build out. Once you have that kind of locked, which in my opinion is still 5, 10, 15 years away, you then have kind of this data center layer, which sits in the middle. The way I think about the data center as it relates to AI is how do we as end consumers experience this technology? It needs to go from the infrastructure hardware players themselves, like the NVIDIAs, the ones who are powering this cycle, to us on a cell phone or us on a laptop. But where does all that data and all that kind of hardware technology sit. It sits right there in the middle in the data center, and it kind of serves as the middle layer between the core infrastructure and also as the end consumer on the end. So the whole data center layer has a slew of companies. Of course, you can invest in the hardware, which sits in the data center. But then if you look further down the data center value chain, which you see at the bottom where it says foundation, we know, and I'm sure you've seen all over the media, that uh, this rapid build out of the data center is creating kind of constraints on our energy. So we're starting to find new ways like nuclear. Uh, there's liquid cooling, which is becoming more prevalent to kind of cool off all this intense heat that this data is generating. And then, of course, you have the real estate operators themselves, which operate kind of like REITs in a way. Um, so we talked about semiconductors, the hardware, kind of like the picks and shovels. Then we went into the middle layer, which is where it sits before it can reach the end consumer. And then how does it get from the data center to us? How does it go from, an Equinox data center to you on your laptop? That's through the cloud providers. When you use ChatGPT, it's actually being distributed to your phone or to your computer, however you're using it, through Microsoft. When you use Anthropic's model, that's being distributed through Amazon Web Services. So the cloud, that layer is kind of uh, they're generating profits because they're the distribution arm, they're the sales arm of all these models. But B, if you think about what these large language models and what ChatGPT is at the end of the day, it's just a bulk of data. We know that data is gold, so the more data that's being generated, where do you store that? If not in the data center, on the cloud. So the cloud, in my opinion, is kind of the sweet spot because A, you're benefiting from their sales arm, but then B, also the more we use this technology, the more data that's being generated, and the more data that's being generated, we need more cloud storage. So that third layer is very, very crucial, and that's why you're seeing companies like Microsoft, companies like Amazon, a lot of these cloud players really surge, 100, 200, 300% just in the last year. So that's kind of the way we look at it. And now that we have these three layers in mind, we'll kind of go through step by step each one and kind of look at the investment case there. But this slide here, it's a little bit more technical, so we don't need to get into the nitty-gritty. But one thing to consider when you look at this chart is that, again, as I mentioned, when we first started this whole cycle 2 or 3 years ago, all anyone was talking about seemingly was NVIDIA. In our case to investors the whole time is that there are so many more companies to invest in beyond just that. And when you think about NVIDIA and kind of their role within this whole AI revolution, it's the GPU market. They kind of have a monopoly at this point on the GPU market. But what we're seeing now is that the chips needed for AI are expanding far beyond GPUs. So we're starting to see, CPUs and ASICs, which are just kind of like custom chips, start to become more and more prevalent. So we're seeing companies like Google, of course, Meta, Amazon, start to carve out niches within these other subsets of chips. And this is just a long-winded way of me saying that there's a need for chips within this AI revolution that are not being provided by NVIDIA, meaning to say that there's a whole slew of other companies that are yet to see kind of their NVIDIA moment. So it's exciting to think about when you think about that first layer, kind of the hardware. We're still very, very early. We still are about, in my personal opinion, a good 5, 10 years away before the core infrastructure is fully built out, where we can start to look at like new applications and new apps on your phone via generative AI. So this is kind of how we look at the whole hardware space, that first layer that I mentioned on the previous slide. And again, within kind of that infrastructure space, when you think about a GPU, it's not just the chip itself. You need all these different components. You need networking, you need storage, you need cooling systems. So with each new cycle, with each new advancement that NVIDIA comes out with a new chip, it's not just NVIDIA that's benefiting. You need to think about the fact that uh, the hardware systems that they use to store their chips, those also need simultaneous upgrades. The cooling systems that they use to store their chips, those also need simultaneous upgrades. So as the GPU and as kind of that core chip evolves, all these adjacent hardware pieces also need investments to grow. And that's where that CapEx that I showed on the first slide, that these big tech companies are spending on, that's where all this is going. So if you can kind of find these server companies and these networking companies and these cooling companies, they will also continue to see increased investment along NVIDIA's chips. So that's without saying that, the infrastructure, the hardware layer that we talk about is still very, very early. And moving along to kind of the data center aspect, which is what we showed in the middle, the second layer. On the left-hand side here, you can see that U.S. data center activity is at all-time highs. Just in 2024, there was 3.5 gigawatts of new construction built out just here in the U.S. And if you look just 4 years back, we were under 1%. So nearly tripled just in 4 years. And of course, we expect that to only proliferate. If you look at some of the headlines from Microsoft and Meta, they continue to build out these aggressive, massive data centers all over the country. So these companies like Equinix, Core Realty, Digital Realty, which are providing the services and building the data centers for these companies, are in hot demand. And again, on the right-hand side here, this chart, I think, just goes to say another concern we get from investors is that early on in the cycle is very US centric. Of course, that's true. Over 50% of the data centers are here in the US, but we're seeing it very rapidly scale all over the world. China's aggressively building out data centers, Europe, LATAM, and that's because when you think about data center, what is of utmost importance is its proximity to the end user. So as kind of this whole AI story goes global and users all over the world start to use ChatGPT and all these large language models, we need data centers close to them as well so that the data moves very rapidly from the data center itself to the end user. So again, this is a very global story. That's why we think at Global X kind of investing in a global ETF, which invests in companies from all over the world, is probably the best way to play this trend to not miss on any companies. Like we're now seeing Alibaba as kind of a big winner in the last few weeks, which is a Chinese company, of course. And again, just reiterating what I said on the previous slide, but I think this slide kind of really paints the dynamics of just how much of a crucial asset these data centers are. At the chart here, you'll see that vacancy rates were at 3.7% in 2023, which were already very low. But now here in 2025, vacancy rates are at 2%. So it's almost impossible to find a data center to build out these AI operations, which is, of course, if you think about what it's doing for these data center operators, it's driving up profits, it's driving up revenues, it's driving up margins because they're not having to spend incremental, but they're able to charge significantly higher fees. So rental rates are at all-time highs, while vacancy rates are at all-time lows. So that dynamic really, really favors kind of this whole data center middle layer that we talk about, going from the infrastructure to the end user. And with that in mind, I think another selling point on this data center layer is that these are, at the end of the day, real estate plays. So in my view, if you're looking for kind of a conservative way to play this whole AI revolution, investing in these data center REITs gives you the benefit of real estate investing, which oftentimes comes with an income and a little bit more or less risk, but at the same time, it's being benefited from this technological wave. So you're kind of getting the best of both worlds. Conservative real estate, sturdy recurring monthly revenues, but also growing very rapidly because of the need for anywhere to store these AI ecosystems. So in the last 9 years, if you look, actually, data center REITs, which we seek to capture in our AI fund, have actually outperformed the S&P 500. So that's a nice chart, which I think speaks to our thesis. And again, further down the data center ecosystem that I talk about, this is causing a massive strain on our energy infrastructure. We are at this scale, we're not going to be able to power all the data centers that we want to bring to market. So how are we going to do that? We need to look for alternative sources of energy, whether it's nuclear, whether it's clean technologies. So we're starting to see uranium companies, nuclear companies, all sorts of alternative sources of energy companies really start to reap the benefit because there's no denying that we're going to need to tap into those sources in order to make this whole AI revolution happen. If we can't find alternative sources of energy, we're at some point going to reach kind of a cap. And so this is how we're going to do it. And if you look at data center energy demand, we expect that to triple by 2030. So if you think about all these alternative sources, they will reap the benefits. And just for greater context, in 2023, U.S. data centers consumed more energy than all the countries you see here on the right-hand side, which is pretty drastic to think about. And again, just driving this point home, we expect by 2030 the data center power load just here in the US to grow at a 10% growth rate. And if you look on the right-hand side, power demand by 2030 is expected to grow 2.4% here in the US. And if you look at the bulk of where that's coming from, you can see here data centers driving almost 1% of that 2.4%. So we're expecting 35 gigawatts of power to be added to the full ecosystem by 2030, up from about 16 just in 2022, so over doubling. Liquid cooling, again, if you think about an adjacent part of this whole data center ecosystem that you can find ways to kind of participate in this growth, how are we keeping all this data cool enough to work, to not kind of, a lot of these data centers are in, southern parts of the country like Texas. In the summertime, these data centers are at max capacity. They could bust. There's significant risks there. Liquid cooling is kind of becoming a key way to make sure this accelerated computing train carries on. We have no risks. So if you look on the left-hand side here, this is just kind of another slew of companies that we see as kind of the forefront to solve these bottlenecks that we're talking about. And data center cooling, as you see here on the right-hand side, we forecast to grow to about 40 billion by decade's end, up from about 18 billion when we put this chart together. So if you look at all these different themes and all these different, subcomponents of the segments we're talking about, you're noticing a trend that, we're expecting essentially all the overall market of all these little subsegments to nearly to double, triple, oftentimes even quadruple. So just again goes to show just really how early we are in this cycle, and I think that's why you're seeing the market react to a lot of these names in the way that we do. And then again, when we look at adjacent areas, what else is going to benefit from this increasing use of AI in cloud? We know that AI is accelerating mobile traffic growth quite rapidly. At this point, I think everyone's using ChatGPT and a lot of these large language models on cell phones, on end user devices beyond just the laptop. So if you look at a whole slew of companies that are going to need to kind of expand their operations in order to stay in business, would be these cell towers. Think about a company like American Tower, Crown Castle, which you see here on the right-hand side. The number of their cell towers is going to have to exponentially expand in order to meet this rising traffic. Not only are they going to expand their cell towers, but they're also able to charge premiums to companies that want to use them. Think about all these different technologies that we talk about. There's cloud computing, there's social media, now there's AI. All these different technologies and all these different companies from each of these technological waves are fighting for space on those same cell towers. So it's ultimately going to be a game of who can pay the most, where the companies that are charging are going to be the biggest beneficiaries. Margins for these companies have, tripled, quadrupled in the last 4 years because of the fact that they're able to upcharge a lot of these companies without having to, necessarily expand, but just kind of charge more and find the user who's willing to pay that. And of course, there's no shortage of anyone who's willing to pay that, with companies like OpenAI, companies like Anthropic now coming to market and receiving, massive funding. Again, just looking at the fundamentals of this space, these tower operators that we talk about are significantly outpacing the equity appreciation of some of the other sectors that we've seen. If you look at kind of funds from operation, market cap growth, just in the last 10 years, they've all expanded rapidly, far faster than several other industries that we cover here at Global X. So, cell towers aren't a super sexy, exciting kind of industry to talk about, but I think it's important to just recognize and just shows kind of the broadening out of the ways that we as investors can play this space. And again, if you think about US cell towers, it of course gives you kind of that a little bit more of that conservative approach to play this space. And then as we move kind of to this third cycle into the end user, if you think about smartphones, or you think about kind of VR headsets, Apple Watches, electric vehicles, I think at the end of the cycle, these will be the biggest beneficiaries because, think about Apple and their iPhones. Apple iPhone sales kind of declined over the last 5-10 years. The reason for that is because there wasn't really anything new and unique that they could offer their users to incentivize them to buy a new iPhone. But now if, Apple comes to market with some new sort of AI feature, or the Apple Watch, or these health wearables come to market with sharp and unique AI features, uh, I think there's no denying that us as users will be willing to buy a new one and spend 5, 10, 15% more to kind of get the latest and greatest feature. So smartphones, we think, are on the rise. I think it's going to really accelerate kind of that upgrade cycle. And that's what you'll see here on the right-hand side. For example, by 2030, we think that 80% of iPhones will run on this new AI system that Apple comes out with, and anyone without the newest system will be left behind without those features. So you can imagine just how rapidly and aggressively everyone will move to that new phone, to fear kind of missing out or to be left behind. You won't be able to participate in the same apps that all your peers are using, so on and so forth. And Apple is a good case study, but this is going to happen with everything, whether it's an Apple Watch, whether it's a Tesla, whether it's a PlayStation, an Xbox. Every kind of end user device is going to have massive AI upgrades, and because of that, they're going to be able to charge significant premiums, and consumers, unfortunately, are going to be, in my opinion, willing to pay that, whether they want to or not. So I think that the end user device is the ultimate beneficiary. And when we think about apps on the iPhone, for example, think about a company like Netflix, or a company like Instagram. These are apps that are already sitting on the iPhone. They already have massive user bases. If they're then able to kind of create an app with an AI feature, there's no denying that there are already millions and billions of users will be willing to spend an extra 5, 10% to kind of get that enhancement. So applications and kind of end user devices at the end of the cycle, in my opinion, will be the biggest beneficiaries. Not only A, because everyone will have to upgrade, but B, because they're able to charge kind of that recurring software as a service monthly revenue. And we've seen this play out with every technological cycle of the past. When you think about the internet, for example, at the beginning of the cycle, it was these hardware companies, it was these chips that enabled the whole internet revolution to happen. But now when you think about the internet, you're not thinking about Cisco, you're not thinking about Intel, you're not thinking about HP, you're thinking about Instagram, Meta, you're thinking about Amazon, you're thinking about these social media winners. So this is my long-winded way of saying that, if you stick around with a cycle long enough, 5, 10, 15 years, the biggest beneficiaries are always going to be the companies that are able to kind of bottle it up into an app, into some sort of service that they can sell to users, and charge a monthly recurring revenue where users have to either come back every few years and buy the latest and greatest, or they just pay kind of a monthly subscription fee. And that's what's going to happen with AI. Right now, the winners are NVIDIA, AMD, a lot of these hardware companies that are, creating the revolution. But think 5, 10, 15 years down the line. We have ChatGPT right now, which is kind of the winner app. There is going to be an app for every single thing you can think about, whether it's healthcare, whether it's logistics, whether it's industrials. And these are all apps that are going to generate, billions of dollars in annual revenue that we can't even think about right now because we don't see the full picture yet. So we as investors, we need to look beyond just kind of these core companies that everyone's been talking about for the last 2 years, and just vision 5, 10 years down the line. There's going to be a very niche ChatGPT-like version for healthcare, for doctors to use. There's going to be a very niche ChatGPT-like version for U.S. financial advisors to use, for logistics professionals. Every industry is going to have its very niche and sophisticated tool, and that's still 5, 10, 15 years away. So in my opinion, if you're looking for kind of the long-term way to play this, think about all the apps and all the different industries that will benefit once kind of that core infrastructure is in place. And that's what we're building out right now. And of course, that's why you're seeing the market really kind of reward companies like NVIDIA, AMD, on the private side, OpenAI, CoreWeave is now public, but you get the gist. And again, just reiterating kind of these end devices that we talk about, remote patient monitoring, think about like an Apple Watch or like a Whoop. These are all devices that once they start to see kind of their generative AI upgrades, we'll start to see, massive increased adoption. At this point, in 2024, only about 30% of the US population was, had access to something like an Apple Watch or a Whoop or some sort of, heart monitor. Once you start to get infused with AI and really sophisticated data, I think these sales are going to be on the rise. We're starting to see AI really proliferate kind of the medical industry. Healthcare is a sector that's going to be disrupted very aggressively by the use of AI. And I think on the left-hand side here, it's kind of everything that I was talking about. PC, laptops, mobile phones, fixed phones, everything is going to at one point uh, far faster than you can expect be integrated with AI and IoT, kind of the Internet of Things, sensors, devices. All these are different unique ways you can kind of play at this trend. So with that in mind, that's the end of the content I had. I will turn it over to questions here, but I think we showed this chart at the beginning, kind of this S-shaped curve of adoption and where we are along the cycle. We think that at Global X, we forecasted about $1.3 trillion in revenues stemming from just generative AI itself by 2032. And this is, of course, a result of kind of everything, a culmination of everything we're talking about: hardware, software, services, ads, gaming, everything coming together at once, boosting labor productivity, boosting GDP growth, making products better, making workers, more productive. So again, AI, I think, is in that sweet spot that we talked about at the beginning, that early majorities phase, where we have at this point a large enough ecosystem of companies that we as investors can invest in, as I showed, throughout the slide. But at the same time, still very early in its trajectory. And of course, at this point, we're kind of in the stage where we know that a lot of these companies are not going bust. They have very sturdy, balance sheets. Earnings are very strong. Guidance is very strong. But at the same point, still very, very early. The data center layer that we talked about, it's a little bit more in that late majority cycle, and that's why we consider it a little bit more, conservative. At this point, a lot of these companies are kicking off yields, dividends. So if you're looking for maybe kind of a safer way, a slower growth, but less risk way to play this space, I would advise kind of that data center ecosystem, cell towers, everything we talked about. And then a little bit earlier on in the cycle is Internet of Things, and that's what I talked about at the end. Apple Watches, IoT devices, and we don't have it here on this chart, but applications and like software as a service would be in that early adopters phase as well. So think about that as well. So those are really the four ways that we at Global X capitalize on this trend, via the funds that we currently have in market. So I know that was quite a bit of information. With that, I'll turn it back over.
Well, Ido, thank you so much for your time again, late on the evening. It's now almost 8 o'clock where you are, and we really, really appreciate you joining us and sharing this information. This was recorded, so our if anybody missed it, will be up on the website in a few days. And again, just appreciate your partnership and your partner, Allie Sullivan, who isn't on camera, but she helped coordinate all of this behind the scenes. So thank you so much, Allie, and you guys have a great evening. If you have any questions and want to follow up, go ahead and email us or give us a call. We'd love to see you again and hope you have a great rest of your evening. Take care, everybody.